How's it going, James?
Oh, I'm doing well. How about yourself?
Good. Thanks for joining us.
Oh, of course. No problem. Thanks for having me.
Yeah.
Always fun. What's today? Wednesday? Thursday?
Thursday, yeah.
Yeah.
So everybody's kind of gotten used to myself providing some monthly updates. My condolences to them for having to see my mug every single month. But one of the biggest questions that I often get from those who are watching the segment is great updates. Like to hear about the markets, but what do you guys manage again?
Right.
And so we thought over the next number of months, we would reintroduce Matco's investment platform. As an asset management and wealth management firm, we manage 5 core strategies internally. And then obviously we also assist clients with the wealth management aspect. So thanks for joining us. Appreciate you coming today. Maybe for starters, when did you join Matco?
So I would have joined Matco in 2022. Before that, I was working at a commodity and oil brokerage firm. I started off in a couple different finance jobs, but with one of the banks here in town, and worked on one of their investment management platforms.
Yeah. So from an industry perspective, what's kind of the full time frame that you've been in the finance and investment and trading related industry as a whole? Not to age ourselves, but we're
13 years.
13 years, yeah.
Yeah, 13 years.
And even thinking back, I mean, time flies. It's been 4 years. At times, I think it feels like it was, last year that you joined us, but then at times it feels like you've always been a part of the team. And I think that's because you've always fit in with the team so well. Maybe to kind of...
It's a pretty good group.
Yeah,
it's a pretty good group, right? We
have
have fun.
Maybe to stay a little bit more on the personal bent, what originally drew you to finance and the investment industry that's landed you here at the end of the day?
I don't know. It's one of the things that I really like about this job is you get to be really curious.
Yeah.
And that curiosity you can express as you're going through and selecting investments.
Yeah.
You can express that in your interest and passion with clients. So I just really enjoy it because I like being curious. I like asking better questions. And I think that the best part about it is that you get to ask better. You learn to ask better and better questions as you go along.
Yeah. I think curiosity is actually a perfect segue into our discussion about global equity because everybody who's been watching is curious about, again, what is it that you guys manage? So again, in form of introduction, your lead portfolio manager of the global equity mandate. Maybe give us a bit of a kind of 101 or intro or refresher on what exactly is the global equity fund.
Yeah, sure. So maybe I'll start with the asset class, right? So we invest primarily in publicly traded stocks, right? So we go buy company shares out in the public market. We would typically be more large capitalization, so larger company biased. If you're a Canadian investor, think like RBC kind of thing, right? If we're in the US, we're looking at something like an Alphabet, or you're looking at something like a Lowe's or a Home Depot, like some of those larger companies that typically have a relatively high quality balance sheet and business model. We don't spend a lot of capital in terms of allocating money to things that would be more kind of speculative. So we typically don't participate in a lot of IPOs. We typically don't really look to anything that isn't publicly traded. We like liquidity.
Yeah.
The ultimate goal for the strategy is to be a core portfolio holding.
Yeah.
And so what that means to us is that you want to have an ability to make money, obviously, and you want to be able to generate some capital returns over time that are competitive and attractive. But you don't want to do that with taking on kind of too much risk, whether that's risk in terms of the volatility or the deviation of your returns over time, or if it's kind of company specific risks like, hey, we're going to do something really cool, but we're going to do it 5 years from now. So I need your money today so that I can build it out so I can do something cool 5 years from now.
Yeah.
We typically would stay away from something like that. We prefer maybe a out of favor business or company that we think has good potential and maybe is just mispriced, as opposed to a coming soon story.
One of the things that often comes up, so I'll ask the question bluntly, but one of the things that often comes up is what should be in my portfolio or which investment strategies are, who is the global equity fund and investment strategy built for? Who should invest in it, do you think?
Right. So to, this is a bit of a cheesy answer, and I'm going to come off like I'm just talking my own book,
Yeah.
but basically everybody.
Yeah.
It's really more of a question of what size or allocation are you thinking about, right? And so if you're, someone that's in an accumulation phase, kind of pre-retirement, you're probably more equity biased. Doesn't mean you're 100% equity, but you're more equity biased, and so that's a pretty good opportunity for some global equity to kind of anchor that portfolio.
Yeah.
Then, you might go off for something that's a little bit more growthy, or it's got some more kind of unique exposure to it. But global is a pretty good anchor to that portfolio.
Yeah.
For the retirees that are out there, one of the problems when you're retired is that you need income. And so we don't have a big dividend yield or distribution from the fund. But for a retiree, the challenge is that you've still got this thing called inflation that you have to contend with. And so...
And even reserving capital base or preserving capital base over time. Like you need some growth over and above inflation, even if your reliance is on income for obvious reasons. Yeah.
Exactly. So you might not have 75% in global if you're kind of in the midst of your golden years, but some allocation helps in inflation protection and some capital appreciation.
Yeah.
And then, the kind of transfer mindset, hey, I'm going to outlive my money and I'm thinking about giving it to the next generation or a nonprofit or what have you. Because that time frame changes quite a bit, then that equity allocation makes a lot of sense.
Yeah. And you touched on something saying we don't have within global equity a large yield or dividend or distribution. So maybe a bit of a, again, segue into, but what is the primary objective of global equity?
Yeah. So I mean, I think there's kind of three different things that as an investor you're thinking about when you look at corporate earnings, right? So you can benefit as an investor from corporate earnings if they get reinvested in the business, or on the other extreme, you can benefit from corporate earnings if they get paid out as a dividend, right? And then there's everything kind of in the middle.
Between, yeah.
So for us, one of the things is that we want to be tax aware. And so if I go generate a really big dividend yield from foreign companies, it's a lot more tax. It's taxed a lot more aggressively than if you go buy higher dividend stocks in Canada.
Yeah.
And so we're not really doing you a favor going out and getting a 4.5% yield in Europe or something.
Not to mention you can do that in Canada.
Exactly. Right. Not to mention you can do that in Canada.
More easily than a lot of other regions. Yeah.
Exactly. And then you're not dealing with currency and all that good stuff.
Yeah.
So for us, we're thinking more about how do we benefit from the reinvestment of corporate earnings back into a business, and can we complement what we would typically see in a Canadian investor's portfolio, right?
Yeah.
So in Canada, we've got this great sector called financials. They've been doing pretty well lately, right? You've got a really good sector in energy. You got a really good sector in mining materials. So what can we do to help benefit from a diversification standpoint? Technology, pretty good fit.
Yeah.
Obviously Shopify in Canada does well, but that's tongue in cheek the only technology name.
Yeah.
I know it's not.
I often joke myself that we have like two. We have more technology companies than that, but when you look at the scale of our technology companies for international investors to invest in Canada, it's like Constellation Software and Shopify. Exactly. And then the odd one kind of bubbles up or disappears over time.
Yeah.
In the US, I don't know what the number is, but
a lot.
It'd be in the hundreds, it'd be in the thousands probably, right?
For sure.
Yeah.
For sure. And so when we come to global, it's like, okay, well, from a sector exposure, hey, let's try and deliver some diversification or some exposure that you can't otherwise easily get in Canada, right? So technology exposure, what do the industrials look like? What's some of the manufacturing look like? What are some of the kind of high quality consumer discretionary names? Obviously you've got like an Aritzia in Canada that's a fantastic company.
Yeah. Consumer's almost similar, like where we have a few flagship brands that have been born in Canada, but if you looked at the balance of where the brands that we know as consumables or wearables have come from, like Lululemon, Aritzia, I'm sure there's others.
Gildan,
which is a company, but not even necessarily a brand that we would know to wear.
Yeah.
But in the US, I mean, the number's kind of endless as to how many brands we've adopted as Canadians in the consumer
100%.
side of the industry. Yeah.
100%. And then I guess the other part with global, and I don't want to put people to sleep too much, but each region has pros and cons to it, right? So you can go to the US and geez, if you try and run like a really deep value mandate in the US, you're going to have a hard time, right? It's a growthier market. And so it's a lot more challenging to kind of find that attribute. And then same thing, if you go to, Europe and you said, hey, I want to run a tech fund in Europe, and I'm going to get a lot of hate for this, but like you've got SAP, you've got another handful of really good companies, but not nearly the same kind of stack that you can maybe find in the US or Silicon Valley. So, okay, play to the strengths of that market.
Yeah. And you've nailed something I talk about a lot with investors. Each region, and therefore its economy and investment markets, have been dealt a hand. So as an asset manager, asset allocator, go to that market for what's been dealt into their hand. Don't try to find stuff outside of it, because you're kind of leaning into their weaknesses as opposed to their strengths, which I think is what you're touching on there.
For sure.
Kate, now, just to make sure we kind of touch on this at a high level, what's in the global equity fund?
Yeah, so we would typically be in the 60 to 70% range for U.S. equity exposure.
Yeah.
Canada, for the most part, will be, call it 3 to 5%, something like that.
Yeah.
And then the rest of the world makes up effectively the balance. Japan, for example, right now is about a 7% weight in the fund. Emerging markets, I think, is about 9% today. And so there's a whole bunch of other pieces there, but effectively you're getting a fairly well diversified global exposure outside of Canada.
Yeah. So
that's the takeaway.
We've kind of touched on a couple of things. One, not distribution or yield heavy, more growth oriented, because that's what the rest of the world really has to offer more so than Canada. What's in it, 60 to 70% US, and then a little bit of Canada, and then the rest outside. We're always a bit hesitant to get too technical when we're communicating, but I think it's worthwhile for those who are a bit more sophisticated. When it comes to selecting individual companies, are there any specific investment metrics, characteristics of a company? What are you specifically looking for? Like, what makes you say, yes, that's a fit for the US allocation, so on and so forth?
Right. Maybe the best way to describe this is that there's certain qualities at a fundamental level that we want the box to check on, right? We kind of touched on that. So we don't want to deal with things that have a pile of debt that, maybe there's some liquidity issues, what have you. So there's a whole bunch of things that we do to try and narrow that universe down into what we would call investable. And then from that investable, we kind of say, okay, well, what characteristics are we really looking for when we're talking about having reasonable growth at a reasonable price is kind of the underlying philosophy. And so, okay, what does that growth look like? Sales might look like bookings for future revenues. There's a whole bunch of things that we're going to look at. And then the other part that we want to look at and say, well, okay, how reasonable is that valuation relative to what we're going to get from a growth perspective, or what we think we're going to get from a growth perspective? And so you're trying to balance those two kind of competing forces when you're picking those stocks. And that it can be a lot trickier to do than just kind of talk about, right? Because oftentimes what you find is if something's got really good growth, the valuation is going to be really high too, right? Yeah. And so then it's kind of a question of, okay, well, can you understand the growth, and do you understand where that growth's going? And can you get your head around that valuation and not kind of overexpose yourself to a risk that growth doesn't show up, and then maybe you're in a bad spot.
Making sure you don't get too far over your skis looking for opportunity. Finding opportunity at the right entry point.
Exactly.
Inevitably a question, I don't know if it's ever tailored to global equity specifically, but maybe worth asking. Cryptocurrency, any relation in the portfolio?
So not direct crypto. We own a company called Interactive Broker. They've got some interest in indirect exposure into crypto. Same thing. We own Visa and MasterCard, indirect kind of exposure. Somebody would come to me and say, James, I want you to build me a public equity portfolio. And then if I turn around and I give them Bitcoin, I'm not really doing what they've asked me to do.
Yeah.
So obviously you can access that asset class. Fantastic. We do tap into it a little bit indirectly, but we're more concerned about public stocks in the public market.
And part of what I was actually getting at, because the answer to that one's pretty simple, like the minimalist of indirect exposure by companies that are somewhat being infringed upon by it.
Right.
But currency in general, obviously you've got allocations in the US, the rest of the world, a little bit in Canada. How is currency impacting performance or returns?
Yeah.
And then from like a philosophical or management perspective, how do you go about managing those if at all?
Yeah, for sure. So any given time, probably the easiest way to think about it is that if the Canadian dollar is going lower relative to the US dollar, that's a positive impact for performance. And if the Canadian dollar is strengthening against the US dollar, it's kind of a negative performance impact. Now, we've got some currency exposure. We tend to hedge things outside of our US dollar exposure, but we tend to leave that US dollar exposure to float. That currency fluctuation is, in the short run, it can be fairly volatile, but the spread is relatively tight. And in the long term, there's typically reasons why that currency is either appreciating or depreciating against whatever the base currency is.
Is your view
and so
that
we're not as concerned about what's happening to the dollar, because realistically, if we're buying a really solid U.S. company and the U.S. dollar is appreciating, they're doing a pretty good job either domestically or if the U.S. dollar is going down and they've got pretty good international sales, then guess what? They're making a fair amount of money, and you can typically counteract whatever negative is happening with the currency with your underlying investment.
Yeah. So I think what I'm hearing is like the asset allocation and or the investment selection over a longer period of time will far outweigh any kind of currency impact to the.
That would be our view.
Yeah.
That would be our view.
So maybe let's talk a little bit about this year. How's performance been this year, last year?
Mm-hmm.
What's that look like?
Yeah, for sure. So, obviously it's been an interesting year, right? When you've got another kind of major conflict, we got to see some volatility through March. We were able to weather that volatility fairly easily. And so we've been in a pretty strong spot. I believe we finished June at 16.3% year to date for Series O. And by July was a little bit of a softer month. And I think we're in the kind of 12%, give or take.
Gotcha. Well, maybe let's take a second to touch on AI, because AI has been obviously a huge, the beginning of, a technology innovation. It's a global topic because a lot of regions around the world are building out infrastructure, building out technology related to it. Mm-hmm. Has Global Equity been participating in AI? What does that look like? Yep. Through what types of companies? Yeah.
So maybe if we just take a kind of a step back, you've got a whole value chain behind AI. So you've got your large language models. So that would be your ChatGPTs, your Claudes, your Copilots, all that sort of stuff. Yeah. Then you've got your infrastructure that sits kind of behind the model. So that's the data center. Inside the data center, you've got your chips. And there's a whole thing about, okay, who's providing the chips? There's a NVIDIA, AMD, et cetera, et cetera. You've got chip designers like Broadcom sort of thing. Then you've got chip manufacturing. And then you've got all the equipment that goes into providing the facility to actually go manufacture the chips.
Yeah.
And so we've spent more time and allocated more capital in the manufacturing value chain than we have at the model level to date. Our view is that effectively we're short compute if the growth in the models shows up the way that we think it will.
Yeah.
And effectively we're seeing that from from when the first kind of ChatGPT model went mainstream in 22 to today, we've been effectively kind of short compute. Yeah. And so rather than trying to compete about who's going to have the best model, let's try and address the problem of a shortage of compute power first. I think longer term, you'll remember, and I'm sure some people in the audience will remember, the battle for internet search, right? So you had Yahoo, you had Google, you had Microsoft Bing, you had, what was it, AOL?
AOL, yeah.
They were all competing for who's going to be the best search engine and who's going to get all the people to use the search engine. Well, Google ended up winning that battle, and through that resulted a whole bunch of consolidation. And so on the LLM front, I think there's 18 or 20 different models, some obviously that are kind of paid, some that are open source. Likely that turns into some degree of commoditization or consolidation. And so if you were to pick the one or two companies that end up with the best models, yeah, sure, you're going to make a lot of money. But there's a whole nother piece there where if the world's short compute, well, I don't really care what model you use. I just need you to use a model. Yeah. And so our view has been that's probably a better risk-adjusted return to gain exposure to AI.
Yeah. The build out needs to happen. The hardware, the infrastructure, the chips, like it all needs to be part of it.
Yes.
I think we would all agree like the development of AI provides significant utility, whether you're talking about using it within a company, within a specific role at a company, or as a consumer, as an individual. That debate has probably been settled. But to your point, to try and pick what the large language model is going to look like, who's going to be the one to build it, is there going to be one that really emerges, or is it going to be all of them constantly competing? But that build out has to happen regardless.
For sure.
Now, as it relates to this year, what are you most proud of within Global Equity as a fund or as an investment strategy?
I think one of the things that we've done a really good job with is staying quite disciplined. Yeah. And that can be really hard to do when there's all this noise going on in the marketplace. And so when the opportunity has presented itself, we've gotten fairly aggressive. And when the opportunity has maybe not looked as attractive, we have not been as aggressive.
Mm-hmm.
And I don't want that to be taken as, oh, James, you're just sitting there and trying to market time. But to give you a good example, like Trump's Liberation Day in April of 25, all of the different valuation metrics that we were looking at kind of came into our strike zone. And it was like, okay, here's kind of what we've been waiting for through 2024 for an opportunity to get a little bit more aggressive. And we were able to execute on that. And now we've been subsequently kind of moving the portfolio back from being aggressive for us. We were typically kind of fairly conservative, but more aggressive to neutral.
Mm-hmm.
And neutral doesn't mean that you're running away from the market, but you're recognizing that, hey, earnings growth has been really strong. Valuations have gotten a little bit stretched. And there's some pockets or some unease out there about monetary policy. And so, do I want to own something that's at 60 times earnings? Like probably not.
Yeah.
So we've taken some of that risk exposure out of the portfolio. And I think we've added to things that have a little bit more reasonable valuations to them with the thought that they'll hold up pretty well if we get some more volatility. And guess what? If the valuation and kind of the metrics that we're looking for fall back in the strike zone, like we will get more aggressive again.
Yeah. I love your answer because you jumped right into the management of the fund and the why it's done well over time, but more the nitty gritty. And you're the lead portfolio manager, so that makes a ton of sense. When I kind of take a step back, and maybe some of it's humility because I know you're a pretty humble guy as well. When I take a step back, Global Equity Mandate wasn't one of our original 3 mandates when we started as a firm in 2006. We were always managing global equity assets within the balance solution, but 2017 was when we actually created a standalone investment strategy for it. And at which point in time, obviously, it wouldn't have been the size that it is now. So I guess when I take a step back, it's that full evolution of it over time where it was part of something. Now it's standing on its own, and it's grown substantially since it stood on its own because there's been interest in it, but also because it's done well. I mean, it's been managed with discipline. It's been managed with that growth objective in mind, but being able to navigate through different market conditions. Because even since 2017, that's only, call it 9 years. We've been through a lot in 9 years. We've been through COVID. We've been through the inflation and interest rate bout of 2022. We've now embarked on, call it geopolitical disruption or a war. So it's been through a lot, but it's been able to stand the test of time. So I'm going to throw that little pat on the back in there for you because I don't know if you were going to ever go there, but I think it is something to at least be thought about for sure. For sure. And I think having, I appreciate it for one, and for two, anytime you get a challenge in the marketplace, there's opportunities that show up. And so it's a question of, okay, do you know what you're looking for? And are you willing to pull the trigger? And that's really why we do what we do, and why we are kind of boring, for lack of a better term, when we sit down and have some of these conversations, is because it's like, well, I haven't really seen what I want yet, so I'm waiting. How big's the fund now? So we're up to 200, little over 200 million now. 210 or 212. And we won't get too much into technical, but there's 2 series available. Series F, Series O, and available on a variety of platforms for Series F. And then I guess kind of a bolt onto that, there is a U.S. equity sub-strategy, but not the core part of Global Equity Mandate itself. Now, kind of shifting gears a little bit, what does James's life look like outside of the office? Are you wearing a suit and a button down on Saturdays and Sundays? Are you a weekend warrior? What does that look like? Well, my wife and I have a 1-year-old at home, so if I was to wear a suit, it would probably have a bit of a mess on it. So needless to say, hobbies have changed quite a bit in the last kind of year. So it's a little bit more family time, that sort of thing. When I do get some spare time, really like to cycle, like to go biking, and kind of wintertime, get out to the mountains, go skiing, go snowboarding, just try and get out and get some fresh air. Where do you hail from? What are the original? It's so unoriginal, but it kind of is original. Born and raised here in Calgary. Here in Calgary. So there's not too many of us, I guess. But yeah, born and raised here in Calgary. Perfect. Well, thanks for taking the time. I appreciate it. I really enjoyed this. I think we should probably do it again because it's good to, I guess, remind everybody what we do, but also get a little bit more in depth about what it is exactly that we manage for our investors. For sure. Thanks, James. I appreciate it. Thank you.